No one could have anticipated that overnight, the Trump administration would make three significant concessions. At midnight on April 23, Beijing time, US Treasury Secretary Mnuchin stated that the trade war with China was unsustainable and that a détente in the situation was expected. Just an hour later, at 1 a.m., Trump himself remarked that a 145% tariff was too high, indicating that tariffs on Chinese goods would be significantly reduced. He emphasized that while the tariffs wouldn't be cut to zero, China would be satisfied with the final tariff rates. Subsequently, White House Press Secretary Leavitt told a news conference that Trump was laying the groundwork for a trade deal with China. Then, at 5 a.m., Trump expressed his frustration with the Federal Reserve's failure to lower interest rates, but clarified that he had no intention of firing Fed Chair Powell. He merely hoped that Powell would be more proactive in implementing rate cuts. These moves by the Trump administration temporarily alleviated market panic, triggering a broad-based rally. The US dollar index briefly surged above 99, rebounding after previously breaking below the 98 mark. It had already plummeted nearly 10% this year. All three major US stock indexes climbed by nearly 3%, while US Treasury bond yields dropped significantly. This positive sentiment rippled through Asian stock markets as well. By the close of trading, the Hang Seng Index and Hang Seng Tech Index soared by 2.37% and 3.07%, respectively. The Chinese yuan strengthened against the US dollar, trading below 7.3. The rare sight of both the yuan and the US dollar index rising simultaneously emerged, with the offshore yuan strengthening by nearly 300 pips to 7.2869 compared to the previous day. In contrast, gold prices, which had hit a new high of $3,500, crashed. During the Asian trading session, the spot price of gold plummeted to around $3,300, and Shanghai gold futures tumbled by 5%. So, why did Trump backtrack? Market analysts attribute this shift to several key factors. Firstly, his approval ratings have taken a significant hit. According to a Reuters Ipsos poll, Trump's support has slumped to the lowest level since his return to the White House. Currently, only about 42% of respondents approve of his performance, down from 43% 3 weeks ago and 47% on January 20th, the day of his inauguration. Approximately 59% of respondents believe that the US is losing its credibility on the global stage. Secondly, tariff negotiations have proven far more challenging than Trump has let on. So far, the US has failed to reach agreements with Japan and South Korea. Japan's Prime Minister has clearly stated that Japan will not make major concessions and is in no rush to finalize a deal. South Korea's Foreign Minister, regarding the upcoming trade consultations between the two countries, indicated that the meeting would mainly focus on listening to the US position and presenting preliminary views, with no intention of rushing the negotiations. Given the deadlock with Japan and South Korea, reaching agreements with other major countries seems even more daunting. Thirdly, the continuous decline of the US dollar, US stocks, and US Treasury bonds has put Trump under intense public and financial pressure. Since Trump took office and launched his tariff war, the S&P 500 index has fallen 15%, the Nasdaq index has dropped by over 20%, and the Russell 2000 Small Cap Index has declined by more than 20%, all entering bear market territory. More critically, the yield on 10-year US Treasury bonds climbed to 4.66%, and the spread between 2-year and 10-year yields widened to 34 basis points. The soaring yields have further fueled concerns about the US government's debt burden. Trump once famously said before his first election, "If the Dow Jones Industrial Average ever plummets more than 1,000 points in a single day, the president should be loaded into a cannon and fired into the sun at high speed, with no excuses." Ironically, he has now exacerbated the very phenomenon he once abhorred. The recent surges in gold prices and the euro are clear signs of the severe damage to the US dollar's credibility caused by his aggressive policies. For instance, when Trump threatened to fire Powell, he was blatantly violating the legal independence of the Federal Reserve. If the Fed were forced to cut rates amidst high inflation, as the market feared, it would trigger a surge in inflation, further erode the dollar's credibility, drive up gold prices even more, and ultimately harm the US economy. Now, with reduced concerns about Powell's job security and eased tariff war tensions, the market has managed to catch its breath, albeit temporarily. However, as the saying goes, actions speak louder than words. On April 22nd, local time, the US Department of Commerce announced heavy-handed tariffs on solar products from Southeast Asian countries. Vietnam faces a staggering 395.5% tariff on solar cells and panels. Thailand 375.2%, Malaysia 34.4%, and Cambodia, which ceased participating in the investigation, is slapped with an astronomical 3,521% tariff. Although these tariffs seem directed at Southeast Asian nations, their true target is China. Firstly, China had just completed diplomatic efforts to strengthen ties with Southeast Asia. From April 14th to 18th, President Xi Jinping visited Vietnam, Malaysia, and Cambodia. During these visits, dozens of bilateral cooperation agreements were exchanged, covering areas such as new-type productive forces, digital economy, and infrastructure connectivity, and joint statements were signed. Naturally, the US felt compelled to respond. Secondly, these tariffs are aimed squarely at Chinese photovoltaic enterprises. Data shows that in 2023, 70% of the US's total imports of solar cell modules came from Southeast Asian countries, and nearly 83% of its total component imports originated there. Approximately 3/4 of the photovoltaic components installed in the US in recent years were sourced from Southeast Asia. Behind these figures lies the fact that most of these products are indirectly exported by Chinese photovoltaic companies through their bases in Southeast Asia. Since 2011, the US has imposed multiple rounds of trade sanctions on Chinese-made photovoltaic products. Due to the combined impact of two anti-dumping and countervailing investigations, direct exports of Chinese photovoltaic products to the US have been effectively blocked in recent years, forcing Chinese companies to shift their production capacity to Southeast Asia, which has since become a major hub for China's overseas photovoltaic production. For Chinese photovoltaic enterprises, the US market is a source of both love and frustration. While the US continues to impose a series of trade sanctions, the market's high premium and profit margins make it incredibly difficult for these companies to walk away. However, with the US imposing anti-dumping and countervailing duties on Southeast Asian countries, the competitive edge of photovoltaic cell products exported from these nations to the US will be significantly eroded. Many industry insiders stated after the preliminary ruling of the US double anti-investigation that this effectively closes off the channel through which Chinese companies export photovoltaic products to the US via Southeast Asia. Clearly, this is no sign of a détente in the trade war. In fact, Trump's softened stance serves two main purposes. On one hand, it's an attempt to relieve domestic pressure. On the other, it's a strategy to create an expectation of positive progress in negotiations, thereby gaining an edge in public opinion and seizing the initiative in the global trade arena. It's a tactical move to break the deadlock and enter the negotiation phase. But once these goals are achieved, there's no doubt that he will revert to extreme pressure on China. Flip-flopping and applying extreme pressure are Trump's tried-and true tactics. A fundamental principle is that the real turning point in the trade war will only come when both sides make clear commitments. Anything short of that is just an illusion. The Chinese Ministry of Foreign Affairs has already made it clear in its response that if the US genuinely wants to resolve issues through dialogue and negotiation, it should stop threatening and blackmailing, and engage with China on the basis of equality, respect, and mutual benefit. In essence, this means that the US should revoke the previously imposed tariffs before any meaningful talks can begin. Trump's so-called backing down won't change the US's offensive stance in the trade war. There are likely to be two possible developments in the future. First, the US may correct some of the damage caused by its arbitrary tariff policies, potentially leading to a structural reduction in tariffs on Chinese goods. Second, instead of mindlessly raising tariffs, the US may use them as bargaining chips in negotiations and seek to form supply chain alliances with allies willing to cooperate. In short, whether Trump backs down or not is not the key issue. What we're seeing is merely a shift in strategy. making it less reckless and destructive. However, the direction of the China-US game won't change fundamentally. It will just ebb and flow. During the lulls, we shouldn't assume the conflict has disappeared. Instead, we should be prepared for the tensions to escalate again. Ultimately, what Trump wants is an agreement similar to the 1980s Plaza Accord. Back then, it was Japan in the crosshairs, now it's China. But this is clearly a non-starter. The US today is not the same as it was in the 1980s, and China is certainly not Japan. Although an agreement acceptable to both sides will eventually be reached, the road ahead will be long and winding, filled with countless strategic moves and rounds of negotiation. Even US Treasury Secretary Mnuchin has explicitly stated that he believes the two countries may reach a broader and more significant agreement within 1 or 2 years, indicating that a resolution is still a long way off. As a result, the global market will remain highly uncertain in the coming period. It often feels like we analyze the situation in great detail, but in the end, market movements still seem to hinge on Trump's actions. For investors, the key is to distinguish between what's certain and what's uncertain. For example, does Trump's softened stance mean that China will reduce its urgency to stimulate domestic consumption? Or, even if Trump eases up, will the People's Bank of China stop buying gold? In fact, gold has become not only a crucial strategic asset, but also an essential Tier 1 asset for banks. The banking sector is becoming increasingly intertwined with gold, and at the heart of this transformation is the final revised version of Basel III. This seemingly ordinary set of bank risk management regulations is, in fact, laying the groundwork for a potential major currency reset. Basel III, formulated by the Bank for International Settlements and adopted by major central banks worldwide, aims to strengthen bank supervision and increase capital adequacy ratios to prevent a repeat of the 2008 financial crisis. Although it was initially scheduled for implementation after the 2009 global financial crisis, it was repeatedly postponed due to events such as the European debt crisis, the 2011 Greek crisis, and the 2016 Brexit. Now, it's set to be fully implemented in the US in July 2025. This is the fundamental reason behind the surge in the price of physical gold and its large-scale return to the US since last year. For decades, gold was classified as a Tier 3 asset, but now it has been reclassified as a Tier 1 asset, allowing banks to count its full value on their balance sheets, putting it on par with cash and US Treasury bonds. This reclassification is due to the net stable funding ratio rule in Basel III, which makes it much harder to suppress the value of physical gold through paper gold contracts. As a result, the market is shifting from paper gold instruments like gold ETFs and gold futures to physical gold. If banks fail to retrieve the gold they've pledged as collateral in a timely manner, they'll be forced to cover their short positions in a rising price market, a situation that could prove disastrous for them. Meanwhile, China's gold holdings provide it with significant leverage in international economic games. Currently, the gold market is overheated with rampant speculation, so short-term caution is definitely warranted. However, in the long run, the fundamental upward trend of gold remains intact.